Business now with Charles. He's starting with some disappointing, though, growth data. This is out of Japan, isn't it?
That's right, Stuart. The Japanese economy grew by 0.2% annually in the last quarter of 2025, which is far lower than estimates, which had that figure at 1.6% growth. It is an improvement on the previous quarter, though, when the GDP actually fell by 2.3% annually. So this means the country narrowly avoided recession, which is traditionally reached with 2 consecutive quarters of contraction. Well, behind the figures is slow private consumption, which only grew by 0.1% and represents more than half of the country's GDP. This as real wages fell by 1.3% last year, putting a strain on household finances. Prime Minister Sanae Takaichi, boosted by her recent lower house election sweep, is looking to supercharge growth, though, by spending to strengthen supply chains and suspending a sales tax on food. Looking forward, the picture looks a little bit rosier in the short term, at least according to the January forecast from the Bank of Japan. Growth in 2025 should reach 0.9% instead of a previous estimate of 0.7%. In 2026, that outlook was lifted from 0.7% in gray to 1% in red, although the forecast for 2027 sees that tapering off.
Stock markets, how have they reacted to this then?
Well, let's have a look. The Nikkei index in Tokyo closed the session on Monday down 0.25 percentage point after climbing over 5% last week on investor optimism regarding Sanae Takaichi's growth-boosting efforts. Other markets in the area closed this Monday and all week for the Lunar New Year festivities. European shares, meanwhile, opening the week higher as investors keep an eye on the Munich Security Conference, where the bloc's leaders and policymakers continue to push for a greater defense spending in order to reach a higher level of autonomy and self-reliance.
Something different for you now. New developments over the potential takeover of Warner Brothers Discovery.
That's right. The media empire, which is a historic Hollywood studio name, is the target of a bidding war between streaming giant Netflix and another historic studio name, Paramount Skydance. Netflix currently has the upper hand after its offer got approved by the Warner Brothers board last year, but Paramount has been lobbying Warner leadership and its shareholders very hard, and the latest reporting suggests this could be paying off. Warner is now reportedly considering reopening sale talks with its rival Paramount. This after it made its most recent offer, which includes quite a few sweeteners, notably offering to cover a $2.8 billion fee owed to Netflix if their agreement with Warner is terminated, as well as offering to backstop or guarantee Warner's debt refinancing efforts, and finally by promising to compensate shareholders if the deal does not go through by year's end, signaling Paramount feels very confident about getting regulatory approval. Just as a reminder, the bidding company here, Paramount, is headed by David Ellison, son of Oracle founder and Trump supporter Larry Ellison. Worth noting that Netflix could also consider upping its own bid in response.
To China, back to China in a way now, the big Lunar Year holiday we talked about, but the government hoping that the country's services sector could be the key to reviving domestic economy.
China is an export juggernaut, but a housing market crash and a weak social safety net have combined to crater consumer demand. One bright spot, though, is China's so-called ice and snow economy of ski resorts, associated hospitality facilities, and winter sports equipment. Its success could be a model for boosting domestic consumption in other sectors. Brian Quinn has the story.
3 hours drive north of Beijing lies the Wanlong ski resort. Open since 2003, it got off to a slow start, often with more staff than guests. But China's hosting of the 2022 Winter Olympics saw its fortune start to improve.
Last ski season, we started making a bit of a profit. This season's even better because we've had double-digit growth in customers. We should exceed 600,000 visitors this year.
China's ice and snow economy, ski resorts, nearby restaurants, and winter sports gear was worth around 122 billion euros last year. The government expects it to grow to around 183 billion by the end of the decade. It's a rare bright spot in the country's slumping consumer landscape and a potential model for planned growth. Services, including things like lift tickets and ski lessons, accounted for just over 46% of per capita spending last year. That's up from around 40% in 2014, but still well below the US figure of 70%. China's household consumption overall is around 20% lower than the global average. The government is reportedly looking at new subsidies to boost that figure, notably for the services sector. Analysts, though, say the plan will require higher household incomes and stronger social welfare programs.
You can't really get this sustained rise in household spending without increasing the household income number. We've seen a lot of talk about efforts to lift consumption and disposable incomes, and I think we'll see a lot more of it.
The details of the government's strategy are expected to be revealed when it unveils its new 5-year plan in March.
Charles, thanks a lot. Charles Pellegrin with Business. Straight to